The first penny stock that I'm quite excited about is KSol's India Limited. It continues to be a standout performer in the IT services microcap space. It is known for its lean operations and specialized high-tech offerings. The company has carved a niche that differentiates it from broad-based IT giants. By early 2026, KSol's has successfully shifted from a generic service provider to a digital engineering specialist. The company has capitalized on the enterprise AI boom by offering custom large language model integrations and machine learning solutions. This is now their fastest growing vertical. KSol's also remains a global leader in niche open source technologies and Salesforce customization, sectors with extremely high switching costs for clients, ensuring a recurring revenue. Their recent results showcase a company that is masterfully managing its growth. It maintains industry-leading EBITDA margins, often exceeding 40%. This is achieved by maintaining a high revenue per employee and low overhead costs. The company's return on capital employed and return on equity are among the highest in the entire Nifty microcap segment, consistently staying above 80 to 90%. It also remains debt-free, allowing it to distribute a significant portion of its profit as dividends. KSol's is also aggressively hiring local sales teams in North America to secure larger multi-million-dollar contracts rather than smaller ticket projects. KSol's is also moving towards a product-led service model, developing its own software tools that can be sold on a subscription basis, further boosting margins. As a founder-led microcap though, a lot of the vision is centralized. Any change in leadership could be a major risk for the stock. While client concentration is also improving, a large portion of the revenue still comes from a small group of international clients. That is always a risk with such a business, especially in a highly volatile geopolitical world. In short, KSol's is a compounder stock. It is not for traders looking for 20% gains in a week. It is for long-term investors who want to benefit from the AI and digitalization supercycle through a company that treats its shareholders well through dividends and transparent growth. Next up is Avantel Limited. It is recognized as a critical strategic asset for the Indian Navy and ISRO. It specializes in indigenous wireless communication and satellite ground station technology. Avantel's strength lies in its specialized product portfolio that high-scale competitors often overlook. They design and manufacture satellite communication systems, HF, VHF and UHF radios, and high-power amplifiers. Avantel is also a long-standing partner of the Indian Navy, providing integrated communication systems for warships and submarines. They provide ground station solutions for ISRO, supporting India's expanding satellite launch missions, including the Gaganyaan mission support. Leading into 2026, the company's financial trajectory has been categorized by profitability over volume. Their operating margins are consistently high, ranging between 28 to 35%. This is due to the high-value R&D-driven nature of their defense contracts. Avantel remains one of the few manufacturing companies in the defense sector with virtually zero debt, allowing it to fund R&D through internal cash flows. They also work at a very high capital efficiency. They generate significant revenue with a relatively small physical infrastructure. With the government banning the import of several types of communication gear, Avantel is the default beneficiary of domestic procurement orders. As India opens up space missions to private players, Avantel's expertise in ground stations and satellite components makes it an essential vendor for new space startups. There is emerging interest from friendly foreign nations in Avantel's low-cost, high-reliability SATCOM systems, which could provide a second growth engine by 2027. Its key challenge lies in customer concentration though, as is true for most microcaps. The Indian Navy and ISRO are the primary clients. Any budgetary delays or policy shifts in these two organizations can disproportionately affect Avantel's quarterly performance. Next up is Gujarat Themis Biosin Limited, which is the pharma tech play. It stands as a unique, highly efficient microcap player in the Indian pharmaceutical space, specifically within the fermentation-based bulk drug segment. GTBL is primarily a contract manufacturer of rifampicin, a critical anti-tuberculosis drug, and other fermentation-derived active pharmaceutical ingredients. Fermentation is a complex biologically sensitive process that is difficult to master and scale, as anyone who's ever tried to bake a cake can tell you. GTBL's decades of experience in this niche provide it with a significant barrier to entry against new competitors. The company has a long-standing technical and commercial relationship with Themis Medicare, which provides it with steady offtake and technical support. GTBL is often cited for having some of the cleanest financial metrics in the microcap pharma world. It maintains exceptional operating profit margins, often hovering between 35% and 45%. Its ROC, or return on capital employed, and return on equity are routinely above 30%, indicating superior capital allocation. The company is virtually debt-free, which is a massive advantage in a high interest rate environment. The recent multi-bagger move in the stock has been driven by a shift in strategy. By early 2026, the company has operationalized its recent capacity expansions at its Vapi plant, allowing for high volumes of high-margin APIs. GTBL is moving from being a pure contract manufacturer to developing its own intellectual property in the fermentation space, which could lead to even higher margins in 2027-2028 window. The stock is trading at a P of 25 to 30x, which is not cheap. It is, however, fair rare given its high return ratios and zero debt. While predominantly retail held, there has been a noticeable uptick in domestic institutional investor interest over the last 2 quarters as the company's expansion plans began showing in the bottom line. GTBL is like a boutique pharma factory. It doesn't make everything, but what it does make, it makes more efficiently and profitably than almost anyone else in India. It is a classic compounder, good for a 3 to 5 year portfolio, though it requires patience as microcaps can remain sideways for long periods. Fourth is Satlokar Synergies ENC Global Limited. Satlokar Synergies is a rapidly growing EPC that has become a dark horse in the Indian SME sector. Satlokar is not a traditional infrastructure builder. They're a synergistic EPC partner. They focus on building integrated industrial facilities, warehouses, and specialized manufacturing plants. A major catalyst in 2026 is their specialization in LEED certified and green industrial buildings. As more companies set up sustainable factories in India, Satlokar is winning high margin contracts that regular contractors cannot bid for. They serve sectors ranging from pharmaceuticals and automobiles to FMCG and renewable energy. The financial trajectory of Satlokar has been one of hypergrowth. By January 2026, the company's order book is estimated at about 900 crores. For a company of its size, this provides a multi-year revenue runway. They've maintained a high triple-digit growth rate in net profit over the last 18 months, driven by better project selection and tighter control over raw material procurement. Unlike many EPC firms that get stuck in debt traps, Satlokar has focused on asset-light execution, maintaining a healthy debt-to-equity ratio of approximately 0.35. Satlokar is positioning itself as a leader in net zero industrial construction. As ESG compliance becomes mandatory for global clients, their expertise in solar integrated and water-efficient buildings provides a massive moat. There is a strong outlook for them to partner with energy storage firms like Bundada Engineering to offer integrated battery energy storage systems within the industrial parks that they build. Satlokar Synergies is a high beta growth play though. It is perfect for investors who want exposure to India's manufacturing renaissance through the infrastructure that it houses. It is less of a value stock and more of a growth stock. Investors are paying a premium today for the massive execution that they expect over the next 3 to 5 years.